Hi, this is A.K. from Smart VRC Bhopal, and today's topic is very interesting. Don't hesitate to invest even at the market top. So investors are scary of investing at tops, and what I am going to show you is you need not have to hesitate or no need to be scary even if it is a market top. Why? So there is the BSE Sensitive Index from 1st January 1990 to till date, or 30 years and almost 31 years, we can say. In 31 years, these are the blue colored circles, or the cyan colored circles are representing the major peaks, or I can say the major tops in the past. So basically there are 6-7 peaks, including the present one. We are at almost at market peak of 47,000 index, sensitive index. So these are the dates. These are approximate dates, not the exact dates. And 25th of October 1990, Sensex was 1299. And 28th April 1992, Sensex was 3,896. Likewise, is kept on increasing. And now we are at 40,960 as on 18th December 2020. So these are the approximate peaks. Now, it's very interesting table. Look at it very seriously. What I am going to tell you. On 25th October 1990, market was at peak 1299. Nobody knew that it is a peak. It is later only investors came to know that it was a peak of 1299. Even if you had invested at this peak of 1299, today CAGR returns would have been 12.63%. Yes, CAGR returns, had you invested in Sensex at the peak of 1299 on 25th October 1990, CAGR returns would have been 12.63%. Similarly, popularly known by the Big Bull peak of 1992, on 28th April 1992, Sensex was 3,896. Even if you had invested in Sensex on that day, your returns, CAGR returns would have been 9.07%. On 9th March 2000, your returns, CAGR returns would have been 11.14%. Even on 15th January 2008, the peak when the Sensex was near to 21,000, your CAGR returns 6.72. Similarly, for March, it is 9.21%. And this is February 2020, just a matter of 10 months. And as you can see, the returns are 17.55%. So these are the investments made at the market peak. What I am telling you is the last day of the big bull run. During these occasions, these were pretty big bull runs. And even with that, your total CAGR returns would have been much better than any other investment asset. So the point which I want to convey to you is that don't get theory of market peaks. Let's have some more insights. Now, in terms of the investment, had we invested 1 lakh rupees on 25th October 1990 when the market was at its peak, our total investment would have turned into 36 lakhs. Similarly, for this 12 lakhs, 8 lakhs, 2 lakhs, 1.66 lakhs, and 1.15 lakhs. There is nothing but the CAGR returns converted into amount of rupees to give you the glimpse of the absolute returns you would have made. Now let's consider some particular stocks. Okay, what we have seen is for the Sensex. Now let's go for particular stocks. So first is the Britannia. As you can see, on 9th of March 2020, the share price of Britannia Industries was rupees 50. Had you invested 1 lakh rupees on that day, that was the peak of the market, your returns would have been 74 lakhs. 1 lakh would have converted into 74 lakhs at a CAGR returns of 22.99%. This is only 20 years ago. Had you invested on the peak, yes, the last day of the bull run, your compound returns would have been 23%. 15 January 2008, 28% CAGR. 12th March 2015, these are all the market peaks. Your CAGR returns would have been 24%. And even just 10 months ago, had you invested, that was the peak from where the market crashed due to the COVID concerns. Your returns would have been 16.50%. So it's very, very clear that it is not the market. It is a company. Even in Sensex, it is some of the companies. More of it we will cover later. There is another example that is of HDFC Bank, and the same dates the market was at peak. The CAGR returns would have been 21%, 18%, 19%, and 20%. That is the kind of phenomenal returns even at market peaks. Again, I am repeating, at market peak. We have invested at market peak, not at bottom. Infosys returns 11.47%, CAGR returns 15.4, 13.84, and this year itself on 4th of January, the share price was 776 and today it is 1186, returns of 62%. Bajaj Finance, that is an exceptional story, and on 9th of March 2000, had you invested, that time the price was rupees 3. Yes, adjusted for bonus and stock split. And today, the CAGR returns would have been 43%, 44%, 55%, and 24%, even from the peak of 4th of February 2020. What I have displayed here is the peak of the market. Peak of the stock may be somewhat different, and even the peak date may be 1 or 2 dates here and there. But in totality, it may cancel out, and you can see the returns, and these returns are at market peak. Why such great returns investing at peaks? Have you ever thought of why we are able to generate so much of returns even at peaks? And we are all worried what will happen to the market. Market has shoot up like anything. Market is up by about 65 to 70%, or maybe even more than 70%. Some of the indices from March 2020 lows, and people are scary that we should make an exit. There is a peak. No one knows whether it is a peak or not. Only the time will tell. Only the time will tell. Why we are getting so much high returns even after investing on peaks? Because GDP is growing. When I say GDP is growing, that is the total economy is growing. And if I say the GDP is growing at the rate of 8% from last 40 years, so the growth rate is 8% per annum for 40 years. But in our country, post-independence, our growth rates were about 2 to 2.5% GDP, which kept on increasing steadily. And in 80s, it was about 4%, which kept on increasing. Then it turned into 6% and eventually to 8%. So we are not only growing, but the rate of growth is also growing. So there are it is a kind of double returns, double growth. Economy is accelerating. Why the Sensex is growing? Sensex is growing, of course, because the 30 companies are a part of the Sensex and their profitability is growing, their share price is growing. At the same time, the constituents of the Sensex are regularly being changed by the authorities. So, Sensex constitutes top of the top companies, top of the top 30 companies. That is why Sensex keeps on growing. Anyway, you will be surprised to know that more than 60% of the times market hovers around the latest peak. Latest means the last peak. Yes, you may not have noticed, more than half of the time, more than 60% of the time during last 30 years, Sensex hovers plus minus 10% to the last peak. Let's see. This is the chart, again the same chart, but you can see the shades. This shaded area denotes the Sensex near to the last peak. Near, when I say near, means plus minus 10%. So as you can see, for years together, from here to here, in the middle of the chart, Sensex kept on moving up near to the last peak. If you are waiting for the crash, then you can very well imagine at this point of time, Sensex was 5,000 and till 2008, it went up to 21,000 points. So from 5,000 to 21,000 points, you will not have got any chance to invest. Not only that, Sensex never came down to 5,000 levels ever. And so are the times, even for 2017 or I think 2016 to 2020, again the market was plus minus 10% or 12% to the last peak. So more than 60% of the time market moves around the peak. Also, we will keep on predicting that the market may come down. There is going to be a crash, there is going to be a major correction, and then we will invest. And majority of the investors have lost much more money in predicting the corrections than in real corrections. Because anyway, what they do, when they see that the market keeps on moving, they get a feeling that they have missed the rally, and ultimately they invest at much higher levels and poor quality stocks. There is a very famous quote by Peter Lynch: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So, as I said, even in Sensex, Sensex is comprised of 30 companies. So each of the company is almost a leader in the respective segment, in the respective sector, and that is how Sensex performs pretty well. And there are very few mutual funds or even investors who are able to consistently outperform Sensex. So the best thing to do is to look for in your portfolio the companies you hold and do a KYC. KYC means know your company, what that company is doing. It is not a piece of paper. It is not merely a symbol, what you see on television or on your mobile screen or on your computer screen. There is a company, there is a set of people in the company who are manufacturing some product, who are providing some services, know what they are doing, what the company is doing, how is the owner of the company. And if somebody asks you, then why you are holding this company, then you should be able to explain within 2 minutes what this company does and why you are holding it. That is how you should look for each and every stock in your portfolio. Ultimately, what matters is the company you are invested. Okay, you have done the KYC and you know, yes, there is a good company. So you have to make it a part of your portfolio. And you have to provide some allocation. You have to provide some weightage. Not that one company is having 50% weightage in your portfolio and another one occupying only 1% allocation in your portfolio. There should be a suitable allocation. Suitable allocation, when I say suitable allocation, that means if something wrong happens, then you should not, your company should not, company stock not lose much. But if something phenomenal happens, then there should be phenomenal returns to that stock. That looks very simple. Think again. And ultimately, what matters is, okay, you have invested in stocks, you have built a portfolio, you have very good stocks, but your returns will multiply over a period of time. More the period, more the returns. If you are invested for 5 years, suppose your CAGR returns are 25%. So in a year, you will get 25% returns. In 3 years, you will get 100% returns because of compounding. In 10 years, your money will multiply almost 10 times. In another 10 years, it will become 100 times. That is the power of multiplication. And that is the sole reason why people like investor like Warren Buffett has multiplied his money. It is not only his intelligence, but also his long duration of being into the investing. He is investing from last 80 years. He is investing from 80 years. And I don't think average Indian investor even invests for 8 years. Yes, we should look for long term. This is the long term which multiplies your investment, which creates huge wealth. So I would like to give you an example of Smart Billionaire Picks. It is a part of our most subscribed product, Smart Gains. Here also we are investing from last almost 20 years. And in these 20 years, 1 lakh has been converted into 85.69 lakhs, and that gives a CAGR of 25.53%. And we are on target to multiply this to 100 crores in another 20 or 21 years. So in 40 years, we are going to achieve a magic figure of 100 crores with an investment of only rupees 1 lakh. Yes, this was started on 30th of May 2001, rupees 1 lakh. This is the power of compounding. That is the way to billion. So smart word, find a good company. Yes, check for the enterprising CEO, because it is the CEO which will guide the company, which will take the company to new heights, who will find the way for growth of the company. Come what may, come whatever kind of challenges are there in the economy, he will take care. He will find the way. That is why we are betting on the company as well as the CEO of the company. But that is not the end. There are many companies with good quality, companies with good management, but those companies are available at not cheap valuations, at very high valuations. So you have to look for even the good, attractive valuations. Now, as long as these three combinations are intact, then remain invested. Don't count the number of years. Remain invested. Just take the example of HDFC Bank, Infosys, and many more such companies which have generated tremendous returns, including Bajaj Finance. So there is going to be a question and answer session. You can even use the chat box or raise your hand. I shall ask one by one to unmute. Thank you. Thank you very much. Okay, Mr. Chandan Mehta, he has asked that, is rally in IT sector just started? Will it continue? Just bought on Friday, Tech Mahindra and HCL Tech. Okay, sorry, we don't give any advice. on particular stocks. Yeah, any other query? Should one rebalance? Yeah, rebalancing is always welcome, and every 3-4 months, I should say, every quarter you can rebalance your portfolio because allocations keep on changing because of the up and down in the share price. So if you had purchased Bajaj Finance at 1800 just a couple of months ago, and today it is 5300, 5200, definitely your portfolio allocation for Bajaj Finance must have undergone sea change. Mr. Amit Desai, kindly unmute yourself.
Yeah. Good morning,
Yes.
Mr. Asnani. Can you hear me?
Kindly speak loudly.
Can you hear me?
Yeah. Tell me.
Okay. Good morning, Mr. Asnani. Just
Good morning, sir.
Yes, I can hear you.
Yeah.
Just a general question, not stock specific.
Yeah.
Most of the growth stocks today
Mhm.
are quoting at expensive valuations,
Mhm.
whether in terms of PE or whether in terms of PEG. So much of growth has already been priced in.
Yeah.
My question to you is, how does one, let us say, for example, a stock, high quality growth stock with lot of growth foreseeable in the future, but it is already quoting at a PEG, let us say, of 2 times.
Mhm.
Now, how does one gather the courage to buy this stock at such expensive valuations? That is one. And a related question is also also regarding selling of such highly valued stocks in terms of valuation. So buying and selling.
Yeah. Very interesting. Yes, you are right. And there are many stocks which are quoting at a PEG of between 7 and 8. Of course, with excellent management and they are growth stocks. But what matters is not the PEG alone. What matters is also the rate of growth of the earnings. Because if the stock is available at, say, a PEG ratio of 8, and if the company's earnings per share is rising at the rate of 11% or 12%, then definitely it is very, very expensive. But if a stock is available at, say, the same PEG ratio of 8, and if it is growing at the rate of 100%, earnings are growing at the rate of 100%, then within a year, its PEG ratio will fall from 8 to 4 in next year, from 4 to 2. But in case of a PEG ratio of 8 with a growth rate of 10%, in 1 year, PEG ratio will fall to 7.2, in another, and next, it will fall to 6.4. So it is better to go with the company whose earnings are growing at the rate of 100% rather than with a company whose earnings are growing at the rate of 12% or 15%. And as far as the PEG absolute level is concerned, yes, what you said is correct. Gone are the days when there were many stocks available at a PEG ratio of 1 or 1.5. But today, even good quality, very good quality stocks are not available at a PEG ratio of below 1.5. So, and there are reasons for that because there is an immense liquidity since 2008. Means after 2008, lot of money has flown into the market, and that is why the stock valuations in general are high, and quality stocks will not be available cheap. And in the present circumstance, if the company is growing at the rate of, say, 40%, I would advise investors to hold a stock whose PEG ratio is around 1.75. No need to sell, hold it. And even if it is high, as I said, 40% growth rate, this PEG ratio will fall to 1.4 within a year. So I hope I have answered your query.
Yes, you have. Yes, you have. Thank you. And just on the selling part.
Selling, as I said, you keep on holding it. If the PEG ratio goes beyond 2.25, then also you need not have to totally exit from the stock. You can reduce your weightage to about 3% or 4%, but don't exit from the stock, because there are not many good quality stocks available at 6 or 7 pack. So 2.5, even 2.5 pack is not high if the company is earnings are growing at the rate of 30% or 40%.
All right. Okay.
Okay.
Thank you so much. Thank you.
How long one should stay invested in a stock? That is a query from Lekha Manish. As such, there is no time frame. As I said, as long as the story is good, as long as the management, the CEO is good, as long as the stock is available at attractive valuations, you need not have to exit. Remain invested. Example, HDFC Bank, I have already given you. From last so many years, there are so many decades, the stock is growing at the rate of 20 to 22%. There is nothing to be feared, only to be understood that what is the valuation. When you buy, Madam Tanu Shangle, when you buy a script, what is the initial time horizon one should look at? No need to look at time horizon if you are a long-term investor. As I said, if the 3 conditions are met, then remain invested. Your ultimate objective is create wealth, and wealth can be created only by holding the stock for long term. I hope I answered. Mr. Ramakrishna, at 63 years of age, what would you suggest? Direct investment in stocks or through mutual funds, and what percentage of total investment? Okay. We all know the thumb rule of investing, how much one should invest in stocks. That is 100 minus your age. If you are 63 years of age, then about 35 to 40% of your total investment should be in stocks. As far as the question arises whether one should go through mutual funds or through individual stocks, I would always recommend you to go to direct investment in stocks, because that generates much higher returns. But then under your own, you should have your own experience of generating so high returns, or through an advisor. And as far as age is concerned, 63 years, and normal Indian people have an age of about 80 years. So still there is a long time to multiply your money. What should one review to take a call to hold or sell? As I said, the 3 conditions should meet: a good company, a good CEO, and attractive valuations. Any one of these is not meeting the criteria, then it's time to make an exit. If someone can't devote much time to market, how should they buy stocks? There is a question from Shashi. If you don't have the time, then you can take the advice of an advisor or go to the mutual fund, but don't invest on your own if you don't have the time. One more interesting question, Mr. Ramchandra. He says that why FII is buying and why DII is continuously selling. FII means foreign institutional investors, and DII is domestic institutional investors. So foreign investors are buying and domestic institutions are selling, and you will find that in more than 80% of the cases, of the days rather, I should say, they always behave in opposite way. And why FIIs are buying? As I said, because of the immense liquidity, especially in USA and Europe. They have lots of money there available at almost 0 rate of interest, and they are coming to India. And even if they get 10% returns, they are very, very happy. And why domestic institutions are selling? The reason is we, the people who are investing in mutual funds, most of the mutual funds, they don't have much of the cash. They keep only 3 to 4% cash, or at the most 5%. So why they are selling? their fund manager also knows at times that yes, there is not the time to sell, but because the mutual fund unit holders are selling, so they are forced to sell. That is the reason. One more interesting question Mr. Rajesh has asked. I generally find it difficult to book profits. I recently read one of the many strategies. One was to book 50% of the profits when it price doubles up. Right? Following this, you want to share specific inputs about booking profits. As I said, don't focus on booking profits. Your focus should not be on the share price. Your focus should be on, as I said, valuations. Your focus should be on the CEO, what he is doing, what he is trying to do, what he has said. Had he achieved that? What targets he has set for 2 years, 5 years? Was he able to achieve that? If not, was there any external reason that he couldn't do? So those should be the questions. Profits will automatically flow. As far as the booking profits with 100% price is concerned, I would say that you should look for the allocation in your total portfolio. If it is going beyond 12%, then definitely, personally, I advise always that no stock in your portfolio should have more than 12% weightage, so that you can follow that. You can set on your own how much should be the maximum weightage of a single stock in your portfolio. Mr. Thyagara has asked regarding the tax saving investments. I'm really very sorry. I personally don't do anything to save tax. So I am not the right person to help you to suggest where to invest regarding the tax saving. Okay. How long FIIs will keep investing in India? I do not know. I am not in touch with any FII, so I won't be able to tell you. What I am concerned is about my company's valuations, about my company's everything about my company. So I do not know when FIIs will stop selling or when BI will turn into buyers and all those things. Yeah. Any other queries? Madam, you have any other query? You can unmute yourself.
Yes, sir. Like you said, that no script should be more than 12%. Bank Nifty, along with its gain, is 20% in my portfolio. Do you think I should book profit and bring it down to 12%? Or when you're saying 12%, is it the invested amount or the current value?
So there are two questions. First is whether it is the invested amount or the current value. It is always the current value. It is always the current value. If current value is more than 12% of the stock, then it is my opinion only. Okay, there is no written rule. Individuals can have their own individual rules, set rules. But from my experience, what I have found that what works very well is the 12% maximum limit. And the second is regarding the Bank Nifty. So Bank Nifty itself is a combination of stocks. It is not a single stock. Bank Nifty may have about 10 to 15 banks. I'm not exactly aware how many stocks are there in Bank Nifty. So you should consider it as a sector and not as a particular stock. So going by a particular sector, I normally find that 20 to 25% exposure can be held. Nothing wrong in it. I hope I answered your both the queries.
Yes, like you gave an example of Bajaj Finance. I'm sure people who bought Bajaj Finance at ₹3 never thought that it will, become such a multi-bagger and would give this kind of a return.
Yeah.
When one is buying a stock, you said look at the three things and then look at its weightage in the portfolio. But, normally as a normal retail investor, when I buy a certain script, though I would like to hold it for a long term, but I really do not know if I should hold it for a long term or not, because in my experience what has happened is stocks that were giving me very good returns in a long term have gone down and depleted my returns as well. So now what I do is I put a certain target to it, that okay, if I achieve 50%, 60%, whatever target in an X amount of time, I sell it. It might continue to grow, might not continue to grow, but then, like you said, I lose on the compounding factor.
Yeah.
Right? How to know that, okay, should I book or should I hold, or how to move forward on it?
Okay. Coming to Bajaj Finance, because lot many money has been made by people in Bajaj Finance, and lot many people have exited this stock in very early phase of the growth. Actually, story of Bajaj Finance started in 2008, 2009, when there was a restructuring into the family. So what I said, the three factors: the company, the CEO, and the valuations. Company was decent, but there was no trend in profits for any 3 years, any 3 consecutive years. There was no trend up till 2008-9. So story was not there. CEO was not that good as it should have. Pedigree was good, and valuations were okay, attractive. But then, as I said, out of these 3 conditions, the CEO was missing. It was in 2008-9 that the company got a very good CEO, and the story started from 2010-11. And it was exactly in the month of March or April, I think 2011, when we identified this stock at 62. Yes, 62. And at that time, we didn't know that what is going to happen or what kind of returns it will give. But what we found is, from last 3 years, there was a very clear trend of growing profits. And till date, we have not asked to sell Bajaj Finance in any of our long-term investments, investment products. In the short term, in the medium to long term, in the medium term, we do often give a target of 25%, 30%. And except for the one case, we have advised this stock not less than 18, 19 times since 2011. And every time it has gone up beyond anybody's expectations. Even I'm very sure even the CEO of the company, he never knew that we are going into this fabulous direction. And even today, I'm very optimistic about this company. Of course, the valuations are not that low, and many people have lost job due to COVID, and many people have seen salary cuts. So be very careful. And with this, we conclude today's session. Thank you very much. It was a nice session, nice questions. Thank you.
Thank you so much.
Thank you.